Good day, everyone, and a warm welcome to Ester Industries Q3 and 9-month FY18 Analyst and Investor Conference Call. We have with us today Mr. Arvind Singhania, Chairman, and Mr. Pradeep Kumar Rustagi, the Chief Financial Officer. We will begin this conference call with opening remarks from the management, following which we will have the floor open for interactive Q&A session. Before we begin, I would like to point out that certain statements made in today's discussions may be forward-looking in nature, and a note to that effect was stated in the concall invite sent to you earlier. We trust you've had a chance to go through the documents on financial performance. Also, we request you not to raise any customer or order-specific question. As you are aware, the company had made an announcement earlier. We request you not to raise any customer order-specific question. In this regard, we thank you for your understanding, as the company is bound by confidentiality agreements. Thank you. I would now like to hand over to Mr. Singhania to make his opening remarks.
Thank you, Gavin. Good afternoon, everyone, and welcome to Ester Industries Q3 and 9-month FY18 earnings conference call. I will briefly discuss the key operating developments, post which Pradeep will run you through our key financial highlights for the period. So let me begin the discussion by highlighting some of the key operational developments across our businesses. Starting with the specialty polymer business. We are delighted with the progress we are making in this business. While the current financials may not reveal the true picture and potential of the specialty polymer business, we believe our efforts and investments are beginning to translate. We are well positioned to more than double our FY18 revenues in the coming year and are optimistic of going forward, expanding this further through contributions both from MBO3 as well as other exciting products we are working on. This business is one we are extremely passionate about and are confident that while product concept to launch cycle can take a considerable amount of time, the reward at the end makes it well worth it. Moving on to the film business, as mentioned in previous calls, the sector fundamentals have changed for the better following the demand-supply reaching near parity. Realizations have firmed up in recent times, with volumes remaining steady on the back of better demand. Our continued emphasis is on improving the product mix in the business by increasing the share of high-margin products. At present, value-added products constitute about 20% of the overall basket, and we aim to increase its proportion to 30 to 35% in the next financial year. Our stringent cost-controlling measures will also help us lower our expenses, in turn helping us improve the overall margin profile of the business. The engineering plastics business continues to perform well. The strategy for this business is on similar lines for our film business, wherein the focus remains on increasing the share of high-margin products. I am pleased to report that we have been successful in doing that quarter by quarter. To conclude, I would like to state that we continue to be positive in our outlook and are confident of delivering improving performance on a sustainable basis. While specialty polymer business will continue to be the key catalyst for transforming the business, I am equally optimistic that the profitability profile of our legacy businesses, film and engineering plastics, will improve meaningfully in the coming years. With that, floor to Pradeep, who will run you through our financial performance.
Good afternoon, everyone, and thank you for taking the time out for our call. I trust that all of you have received the investor document circulated by us earlier. Let me quickly summarize the key financial highlights for the quarter and 9 months ended December 17, following which we can begin the Q&A session. Starting with the top line, our revenues from operations for the quarter stood at rupees 202 crores as against 177 crores, higher by 14%. While on a 9-month basis, the same net of excise and GST stood at rupees 586 crores as against 505 crores reported during 9 months FY17, higher by 16%. As mentioned by Mr. Singhania, we are pleased with our revenue run rate, especially considering the fact that H1 was relatively challenging for the business due to effect of GST rollout with effect from 1st July 2017. EBITDA, including other non-operating income and excluding other comprehensive income, for the quarter stood at rupees 16.59 crores as against rupees 11.64 crores generated during Q3 FY17. While on a 9-month basis, the same stood at rupees 47.55 crores as against rupees 34.18 crores reported during 9 months FY17. EBITDA margin for the quarter stood at 8.30%, while on a 9-month basis the same stood at 8.19%. I would just like to mention here that we were able to maintain our margin despite the firming up of raw material prices. In addition to the price increase undertaken recently to offset the impact of input prices, I would also like to state that on cost control has helped us maintain and preserve the margin. Further, our focus on improving product mix by increasing the share of high margin products have contributed positively towards maintaining the margin. Finance cost for the quarter stood at rupees 8.16 crores, while on a 9-month basis the same amounted to rupees 24.72 crores. Depreciation for the quarter stood at rupees 7.85 crores, while on a 9-month basis the same stood at rupees 23.32 crores. Profit after tax for the quarter stood at rupees 48 lakhs as against loss after tax of rupees 351 lakhs reported during Q3 FY17. While on a 9-month basis, loss after tax stood at rupees 31 lakhs versus loss of rupees 10.09 crores generated during 9 months FY18. FY17. This would read as 10.09 crore generated during FY17. Moving on to the segment-wise performance, especially polymers business reported revenues net of excise duty and GST of rupees 10 crore as against rupees 8 crore generated during Q3 FY17. While on a 9-month basis, it remained relatively stable at rupees 37 crores. While the performance for the business remained relatively soft, we are seeing things improve, hopeful of delivering a much better performance in near to medium term. Polyester film business reported revenues net of excise duty and GST was rupees 147 crores during the quarter as against revenues of rupees 132 crores generated during Q3 FY17. While on a 9-month basis, the same stood at rupees 425 crores as against rupees 368 crores reported during 9 months FY17. As mentioned by Mr. Singhania earlier, while the sector's fundamentals have turned for the better on the back of improving demand-supply parity, rising raw material prices may restrict margin expansion. Performance of engineering plastic business continues to improve with net of excise duty and GST revenues for the quarter and 9 months being rupees 44 crores and rupees 125 crores respectively, higher by 22% and 23%. Similar to film business, we are working towards improving the product mix for the business by focusing more on high-margin products. To conclude, I would like to reiterate that a collection of factors that include successful innovation, strategic initiatives towards improving product mix, and driving down costs along with improving sector fundamentals will, we believe, help us deliver better performance going forward. That concludes my opening remarks. We would be happy to answer your questions now.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and 1. The first question is on the line of Saket Kapoor from Kapoor & Company. Please go ahead.
Yes, sir. Good afternoon, friends. Sir, firstly, if you could give us some idea what the sustainable numbers for us, because the numbers are very lumpy quarter on quarter, and you have some. Am I not audible, sir?
Yeah.
So shall I repeat? Hello.
Please repeat the question.
Yes, sir. So I was talking that our quarterly numbers are very lumpy in nature, with lot of variations in profit and losses being posted depending upon the market conditions. So how should investors look at your company how should we benchmark it in terms of earning? What kind of earnings are you endeavoring going forward for FY19, FY20 if you could pencil in something for that, sir, firstly.
Well, what you are asking for is a guidance. We are not giving a guidance, but what we can tell you is the performance of the company going forward in FY19 will be substantially better than FY18.
Okay, sir. And sir, if you could give some idea about what the utilization levels were there for this quarter as well as for the 9 months from the various, both the verticals separately.
Sorry, say again, your voice is not clear.
Sir, I was asking, what were the utilization levels for both the verticals for this quarter as well as for the 9 months?
Well, film is running almost at 100% capacity utilization.
Okay.
And
engineering plastics at about 65 to 70% utilization level.
And specialty polymer, the capacity utilization is very low because we have a very large capacity at almost 30,000 tons per annum.
And we would do about, so currently, let's say around 20% is the capacity utilization in specialty polymer.
Okay, and that will ramp up, sir, to what level for 1 year and 2 years down the line?
I think we've already mentioned in our opening remarks that our specialty polymer business will more than double in FY19.
In terms of
top line.
From 20 to 40%?
No, well, the revenues of the specialty polymer business, which were at about 42 crores in FY17, will close FY18 at a revenue level of about 50 to 55 crores. And we expect for FY19 to more than double the revenues of the specialty polymer business.
Okay. And sir, if you could clarify, what is the depreciation involved for the polymer business? The depreciation amount?
We look at depreciation for the entire company, which is about 7, let's say close to 7 crores per quarter.
For a yearly basis, if you could give the polymer point, then because the depreciation is going to be constant, and then we can get the idea of what can be the bottom line contribution.
So for the company, the depreciation is close to 7.5 crores per quarter. So for the year, it is about 28 to 29 crores.
28 to 29 crores. And sir, lastly, yes, sir, for the company. For the Berkshire part of deal, could you now elaborate more of it? What kind of confirmed orders are there in our hand, and what is the execution period?
I'm sorry, we are not at liberty to talk individual companies and take their names. We are bound by confidentiality agreement.
That was made public by the company only. We came to know.
Yes, I know, but we can't talk about it any further.
Much beyond that.
And but we will substantially increase our specialty polymer business, which has been lying. It has taken us a very long time because the gestation period for product qualifications were very high. So it has taken us a long time, but now it has finally started giving results. So that is the reason we are saying polymer business will more than double its revenue in FY19.
So, sir, just to get the point, then the major contribution of the growth in the polymer business would be on the premise of this order from Berkshire. That much we can conclude.
Yes.
That is the main catalyst for the growth that we are going to witness going forward.
Yes.
Right. And for the raw material front, sir, what back end the job is to be done so that we are not left at the vagaries of the raw material prices volatility, and how have the raw material prices behaved for this quarter as well as for the 9 months?
See, raw material have risen in the last 2 quarters.
Okay.
They've been on a rising trend, but we've been able to pass on. You see, in our specialty polymer business, we have a pass-through system for all our products, that whatever raw material rise takes place, we are able to pass it on. In fact, we have, in most places, we have a raw material linked pricing formula where we fix prices and margins are fixed, and then every month the raw material plus or minus is adjusted in the selling price. As far as film is concerned, we have seen increase from August. The prices had reached about between 75 and 80 rupees a kilo for film, which today are standing at about 112 to 115. The price increase in raw materials has been about
let's say, between PTA and MEG put together has been about 7 to 8 rupees. From 63 rupees, it has gone up to 73, close to 10 rupees.
10 rupees
has been the increase in the raw material prices.
So the raw material basket, if you could give the what is our raw material basket in product?
PTA and MEG.
For film and especially polymer, PTA, pure terephthalic acid, and MEG, monoethylene glycol.
Right, sir.
And for Indian plastics, these are other, there are PBT polymer, PS6, PS66, PC, ABS, etc.
Okay, sir. And the PTA and the MEG mix, sir, in terms of what percentage of raw material is PTA and how much is MEG?
About 86% is PTA.
Okay.
So in percentage terms, it's the stoichiometric 0.86 of PTA and 0.34 of MEG.
Correct.
So in percentage, it will be, let's say, close to 73% would be. No.
Actually, 0.86 kilograms of.
That is how we look
at it. 0.86 kilograms of PTA per kg of chips, and it's 0.33 or 34 kilograms of MEG per kg of chips.
Okay, sir. And you told the PTA availability has improved, I think, so with Reliance coming up with
there is no issue on PTA availability.
Availability is not an issue. It is both the materials and the
prices. Okay. And both are sourced from Reliance only, sir, domestically?
Huh?
Both are sourced domestically only, or are we importing?
No, we are not importing. There are 3 sources of PTA in India and 3 sources of MEG. We buy from Indian Oil and India Glycol MEG, and PTA we buy from MCPI.
Right. Last question, sir.
Mr. Kapoor, may I request you to join the question queue for any follow-up, sir? As you have several participants waiting for their turn.
Thank you.
Thank you. Also, reminder to our participants, anyone who wishes to ask a question at this time, they may please press star and 1. The next question is from the line of Kunal Shah from Elegance Advisors. Please go ahead.
Hi, sir. Good evening, sir. The first question is, sir, what would be our debt levels and the weighted average cost of capital?
So weighted average cost of capital is about 10%, 10.5%. And the debt is about, the interest-bearing debt is about 290 crores, out of which term loan is about 75 crores, and balance 215 crore is the working capital debt.
Okay, so on an average, the interest cost would remain at 35-40 crores, what is there right now, or it is going to further increase, sir?
For the debt we have, it will remain at 35. With the repayments, it will get reduced, and depending on the capex which that we may do in future, it will vary according to the borrowings. The weighted average cost is expected to go beyond 10%.
Okay.
If there is no increase in the interest rates.
Okay. And what, since we are looking at doubling the revenues for the polymer business, what kind of money that would be requiring to, fund the capex?
There is no major capex required for the specialty polymer business.
We told that we are operating at about 20% capacity utilization.
Okay.
So really would not require any capex.
Any major capex. Chota mota kuch hoga, but otherwise no major capex is required.
Perfect, sir. And sir, the polymer business margins, as is put down in the investor presentation, is 14%, that is before interest, right, sir? So at the EBITDA levels, what could be the margins level for the polymer business, sir?
Going forward, we expect this EBIT margins to improve substantially, because as the volume grows, EBIT margins will grow more than proportionally. So going forward, we expect our EBIT margins to be about 30%.
EBIT margins to be about 30%.
For this segment, as you go by this segment.
Okay. So then, considering the volumes we are doing, the blended margins would be around 15 to 16%, sir? Overall, yes, sir. Considering polyester and engineering plastic business put together,
could be anything between 13 to 15%.
Okay, fine, sir. And when we talk about doubling the polymer business, what kind of numbers? 80 to 90 crores kind of number for the next FY?
I think we will be in excess of, it could be anything between 100 to 130 crores.
Okay, 100 to 130 crores.
No, not 200. 100 to 130 crores.
Yeah, sir. 100 to 130 crores. Anywhere between 100 to 130 crores could be the revenue number that would come in for the specialty polymer business. And considering the other traditional business, sir, 5 to 10% growth, or how should we look at it from the next FY point of view, sir?
As far as polyester film is concerned, there is no capacity increase this year.
Okay.
But the margins have improved substantially, and we expect the margins to remain at very healthy levels for the next 2 years, because there has been no capacity expansion. All the capacity expansion which happened last year, the growth rate in the growth in demand for polyester films is at about 12 to 13% per annum.
Okay.
So right now we stand at near parity in terms of demand and supply in polyester film. And that is one of the reasons why we've been able to increase our margins substantially in the last quarter.
Okay.
And going forward, we expect the margins to further improve and remain strong for the next couple of years.
Okay. All fine, sir. Thank you. I'm done, sir. Thank you.
Thank you. The next question is from the line of Ravi Nagtav as an individual investor. Please go ahead.
Good afternoon, sir.
Good afternoon.
Sir, you have recently won an order from US. Sir, what is the potential of this product you see worldwide? Means if you have breakthrough order, so what is the future potential of this product?
Well, the potential for this order for this product is quite good. I think from where we have now reached, we could be looking at another increase of about, if I were to consider this business, overall potential could be in the region of about 4,000 tons per year.
Okay, sir. 4,000 tons. And you have a patent for this product, sir, right?
Yes, we do.
Okay. So you see, sir, other manufacturer of carpet manufacturing shifting to this product?
Yes, we expect some other smaller manufacturers to also get into, who are also evaluating this product, and we expect some further business increases in the coming months.
So, sir, any other product you have developed, you have got any good response beside this product, sir?
Oh yes, we have a pipeline of products under development and qualification at different levels. At different levels of the development stage. So we have products like we've talked about the beer keg product. It's under this product was started about 4 years ago, but then for the last 1.5 to 2 years, the project came to a standstill because our customer had they had a lot of organizational changes, so they could not continue with it. That qualification process with that customer is restarted in January. And we expect to see some results coming in the next couple of months. Apart from that, we have a project. We have projects on washable and what is that? 20-liter water jars. Water dispenser jars.
Okay.
So we have a very good product which can be hot washed at about 75 degrees. So this product is under qualification in various parts of the world, including Latin America, Mexico, in China, in India. So this is another product that is undergoing trials at various customers across the world. And then apart from that, we have 2 other products which are at advanced stages of qualification, which is the MB06, which is a cationic diable master batch, and the MB07, which is the easy diable master batch. The potential for this product is very, very good. We have got some very encouraging results from some of our customers in the last few weeks. And going forward, we see a good potential coming from this business. This business could have a potential of almost 12,000, anything between say about 8 to 12,000 tons per year.
Okay, sir. Sir, do you see this business at an inflection point now, sir?
Yes.
Okay, thank you.
Thank you. Reminder to our participants, anyone who wishes to ask a question on the line, they may please press star and 1. We'll give the next question from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Call.
Hello?
Hello.
Yes?
Yes, Saket.
Hello.
Go ahead.
Yes, Saket.
Yes, sir. Sorry. Sir, I was just dwelling on the point of MEG which you told we are sourcing it from India Glycol. Sir, they are generally the green MEG producer and the product is placed, the price is higher than the traditional prepared from petrochemical. So why are we paying a higher price for?
We are not paying any higher price.
We don't pay any higher price.
Okay, sir.
It is sold at the same rate as petrochemical MEG is given.
Okay, sir. But they have branded as green MEG. That's why I put that query.
So their big customer like Coca-Cola, Pepsi, they charge premium for green MEG, not from us.
Okay. It is market price, sir.
Yes. Market. No difference between their MEG and petrochemical based MEG.
There is no difference. No difference. And what were the prices, sir? Hello. How have the price behaved, sir, for the last quarter?
It has increased a lot in the last 4 to 5 months. MEG prices have increased by about 15 to 16 rupees a kg in the last 4 to 5 months.
Sir, currently, can you give an idea of what have the price been for January, February?
Current price would be about close to 70 rupees net of GST.
70 rupees. And
close to.
And the average for December quarter was?
Average for December quarter, I would need to work out. Give me a minute. You can have another question. I'll just see.
Yes, sir. And sir, the main point for which we are working is how are your utilization levels? You have given us the guidance that the utilization levels are going to improve 2 years down the line. Then only, sir, the actual profitability, what we can expect can be viewed into it. Because right now the levels are all low and you have to pay the depreciation and the interest on the entire part. So the trigger for us is only to understand how sooner your capacity utilization goes up. So that was the only point.
What are you talking about?
Yeah,
Which business are you talking about?
So I'm talking about your the specialty polymer business. That only will improve and the bottom line will be better. Would shape better then only as the utilization levels improve.
Sir, the bottom line is going to improve substantially, not only because of specialty polymer, which is of course one of the major input for the improved bottom line in the coming months, but the bottom line is also going to improve because of polyester film business, where the margins have improved substantially and will become stronger as we go forward.
75% of our revenue comes from polyester film. That is also going to see improvement in the following year.
Okay, sir. Right. Okay, sir. You have the data set for December quarter?
Just a minute. Give me 2 minutes.
Okay, sir. And then the next speaker can come. So you can answer. You can give the price when the next speaker is also there. There is no problem.
Okay.
Thank you, sir.
Thank you. The next question is from the line of Lav Shah from Pinky Ventures Private Limited. Please go ahead.
Good afternoon, gentlemen. Thank you for the opportunity. We're looking at the earnings presentation. We can see that the engineering plastics division has also done well for the recent quarter as well as for the 9 months of the current year. Any outlook that you would like to give on this business? Maybe if you can also talk about the overall industry size and how are we placed and what are the growth avenues that we are foreseeing in this segment?
Well, we expect our revenues going forward to increase by about 15 to 20%. We expect revenue for FY19 to increase by about 15 to 20% in FY19. We are following the similar strategy as in film to see more and more of our product portfolio turn to specialty, which will help improve the bottom line as well.
Okay. So if you could highlight, what are the industries that we are broadly catering to, from this segment?
We are catering to electronic, electrical, and automotive industrial applications.
Okay. And so automotive would be, electronics would be the highest portion of the revenue, or the
electric business is the highest proportion right now. We are working very hard on to make a bigger impact in the automobile sector. So every year, improving our volumes going into the automotive business as well.
Okay. And in the automotive segment, what is the competition? Is this players like Kingfar the competition?
Well, everybody is a competitor. I mean, we have the likes of a lot of the international large players like BASF, DSM, GE, Kingfar, Lanco. They're all there in this business. There are many compounders in this business, and competition is there, but it's a quasi-commodity product. It's not a fully commoditized product, and you have to go through customer qualification process. So while there is a lot of capacity and a lot of competition, we are still able to make a decent margin here.
Okay, so you would say this is a fragmented market, is it?
It is a fragmented market.
Okay. So any idea about what could be the market shares broadly? Who would be the top three players in this in India?
The top three players. Again, you see, when you talk about engineering plastics, it's a very generic terminology, and it depends on which sector. If I were to take our business, which is mostly PBT, nylon 6, nylon 6/6, polycarbonate, etc. Some of our larger competitors would be companies like DSM, BASF, Kingfar, Lanxess, etc.
Okay. Understood. Thank you so much.
Thank you. The next question is from the line of Ashwin Reddy from Samatva Investments. Please go ahead.
Yeah, hi, good afternoon, and congratulations on a good set of numbers. So my question is on the specialty polymers industry. Can you talk a little bit more about the R&D team that you have, the amount that you spend, or how much you expense per year on the R&D that you have on this, and specifically, it's not about specific customer, but in general, is it like customized for a particular customer? Do you work with the customer and then finalize the product, or do you do the R&D yourself and then you take it to the customer? How do you work? I mean, I'm just trying to understand better about the whole process and your R&D bit in the specialty polymers business.
Okay, so we do the R&D ourselves.
Okay.
The entire R&D is done by us in-house with our own people and our own infrastructure. Okay. And then the products are sent to the customers for trials and qualification purposes. So that, and then whatever improvements are required, it goes back and forth. It can happen that we also do customized products for some customers, but there is also a product like MB03 or MB06 or MB07 or our beer keg or our, let us say, easy diable product. These are standard products which we can sell to many customers.
Okay. So and there is no restriction on you selling the same product to some other customer, right? I mean, the customer puts in a restriction.
No.
There's nothing of that sort.
Nothing of that sort.
Oh, okay. And also, I read somewhere that in the news that you're putting up an R&D center in Delhi. Is that done now? Are you investing in that now, or?
We are going to invest in it. We're going to invest in it in the coming few months. We're going to start investing in that R&D center.
Okay. And right now, what are the team size that you have for the R&D team that you have?
About 20 people we have in the R&D team.
Oh, okay. All right. Thank you so much, and good luck.
Thank you.
Thank you. The next question is from the line of Saket Kapoor from Kapoor & Company. Please go ahead.
Sir, I was just dwelling on one more point. So you told that 75% of your turnover is from the film business, and the remaining is from the specialty.
Correctly, yeah.
Correct. At present. And currently our film business is running at around 100% capacity. That is what
near full capacity.
Almost.
Near full capacity. So, sir, as running at near full capacity, we are producing these numbers. That means, sir, what will then improve then that we will be able to cover the finance cost? And what is this the nature of the business that we have to pay finance cost something like 25 crore for 9 months doing business of 600 crore working at full capacity? How are we going to then earn the better margins so that we can break even? That was my question.
Mr. Kapoor, as I've explained, that the film business always runs at near capacity utilization. The margins are decided by the market based on demand-supply scenario. Okay, and let me give you some specific numbers. Last year, our average for base film, which we call as the 12 micron Corona, the contribution, the gross value add on that product in FY17 up to now has been about 30 rupees gross value add. Going forward, we see this number to go beyond 40 rupees.
Okay.
So you can imagine that 10 rupee increase in margins will have a substantial impact on bottom line.
With no inflationary trend. You are only putting in the incremental margin of 10 rupees.
I'm talking margin. I'm not talking about price.
Right, sir.
Secondly, as far as interest cost is concerned, you have to look at the total revenue of the company, not only film business, because the interest cost is for the company. And it is about 4% of the turnover, which is not very high.
Right, sir. So, sir, going forward for FY19, the percentage is going to remain the same, whatever the incremental turnover will be? We
believe that it should be lower than
FY18.
For FY19 would be lower than
as a percentage.
Yeah, as a percentage.
As a percentage of sales, it will be lower than 4%.
Yeah, it would expect it to be lower than 4%.
Right, sir. And so, did you have that price now, sir?
The September quarter, the MEG was at about 62. December, it was about 64, 4.5. March quarter, the current price is about 70 rupees, and for the quarter, it is expected to be about 71, 72.
We are talking now for this March 18 quarter. It is in the trend of 71, 72.
It's not 71, 72 rupees.
Okay, so that means we have locked in our quantity and the rate for this quarter also. It is in advance. Sir, we have locked the quantity and the rate for the entire quarter. It is fixed every month.
We have contracts for our raw materials. For PP and MEG, we have contracts with our suppliers. So availability of raw materials is not an issue.
Not an issue. Only the price is fixed every month, depending upon the import parity price.
Correct.
Right. Thank you for answering, sir. Thank you, sir.
Thank you.
Thank you.
Thank you. We have a follow-up question from the line of Ashwin Reddy from Samatwa Investments. Please go ahead.
Yeah, hi. I just forgot to check with you. So, on the debt, can you talk about how the management thinks about debt for the next 2-3 years? How should we think about the repayment schedules?
So the 75 crore that we have, 8 crore needs to be paid by March 18, and then next year we have to pay about 43 crores, and then 17-18 crores, and then hardly an amount left after that.
Let's say a substantial portion of our repayable debt will be reduced by FY19.
Okay. Yeah, because when you will be generating much more cash in the next 2-3 years. So I was just thinking how we should think about that. Okay, great. And then secondly, on the capex, what is the capex that we expect for the next 2-3 years? What is the cumulative capex across all divisions put together? Maintenance plus.
As far as we'll have normal capex of about 20 crores.
Okay.
10 to 15 crores.
10 to 15 crores will be our normal capex spend, which for a company of our size is a normal number.
Right.
For almost a 900,000 crore company, we'll be spending about 10 to 15 crores on normal capex. Any major capex, we have not yet taken a call.
But in terms of capacity expansion, it looks like right now the focus is on the specialty polymers. So I'm assuming films will not be a big focus area for you going ahead. So we should not expect much capex there. Is that a right thought to have?
Well, it is a focus area. It's the largest contributor to the top line of the company.
Right.
So it is definitely a focus area. And at the appropriate time, we will definitely look at expanding our film business as well.
Okay.
But just to answer your question, we are a prudent company as far as debt is concerned. We don't believe in growth based on a foundation of debt because we have no desire to get into a debt trap. So we want a profitable, sustainable growth, and we will have prudent debt for the growth of our company.
Right. And got it. That's very helpful. And finally, one question on the raw material, on the strategic angle of raw material, because somehow I keep hearing that the capacity expansion of PTA is kind of not happening very easily in India. How do you see the raw material availability going ahead? Because right now
we don't see any issues as far as raw material availability. We have had long relationship with our suppliers. And going forward, we are confident that all our needs will be met by our existing suppliers.
Okay. All right. Okay. Thank you so much.
Thank you. We have the next question from the line of Sunil Jain from Nirmal Bang. Please go ahead.
Yeah, good afternoon, sir.
Good afternoon.
Sir, pardon me if I ask a repetitive question as I was dropped in between. Sir, about this polyester film, what was the capacity utilization in the current quarter?
See, we are running at almost full capacity in polyester film.
Maybe 100% or?
Close to 95%.
No, 100% hota nahi hai.
Okay.
But close to 95% can be considered as almost full capacity utilization.
Do you share the volume figure also of PET film?
Sorry?
Whether you share the volume figures? PET film का कितना volume किया quarter में?
Which quarter you are talking about?
Of the current quarter, third quarter.
Yeah, I'll give you the sales quantity for December quarter. It was 12,600 tons.
Okay. And sir, about this margin, what you had said about the product prices increase and raw material prices increase, that has happened in the fourth quarter or it was there in the third quarter also?
Third quarter was less. The real impact is coming starting in Q4 FY18.
Okay, so whatever you were doing a bit of around 10 crore, that has moved up to 10 rupees to 20 rupees, you're going to say?
No. You see, we had a gross value add of up to now in FY18. The average gross value add was about 30 rupees.
Yeah.
30 rupees. And now going forward, we expect it to be in excess of 40 rupees.
Okay. So, but that gross value add, whatever the extra is coming, will normally get translated into EBITDA or there will be some additional expenses also?
Yes, there will be translated into EBITDA.
Okay, great, sir. And so second thing about your this ME3 product, MB03 product, sir, in this new order, whatever you got, this was the only company where you had supplied a trial order in second quarter, or this is different and that was different?
No. We've been supplying this product for the last 2 years to other companies as well.
You are supplying to another company also, and that this you mean to say is an additional order what we got, which we were expecting apart from the existing our supplier. Okay. So then the guidance you had not increased, sir. What I was expecting, then this would have an impact on the overall revenue guidance for the next year.
I already mentioned that we expect our specialty polymer business to more than double over FY18. So FY18 will end at about 50-55 crores. Yeah. And FY19 would be in the region of 100 to 130 crores revenue in the specialty polymer business with EBIT margins of around 30%.
Oh, great, sir. This guidance, even you had said in the last time also, where this order was not there. My question was coming more from that. So, are we seeing, we were expecting these type of order at that time also?
You see, this is a development business.
Yeah.
And we have now learned out of experience that the gestation period in technology business can be very high. Yeah, sometimes even much more than what we anticipate.
Yeah.
And we've been working in this business for the past 7 years. And with this particular product, we've been working with customers for the past 5 years. Yeah. It took almost 3.5, 4 years for us to crack our first customer. And now we have, we we have this particular product only is going to give us a much higher volume in FY19.
Sir,
technology business is not a quarter-on-quarter business.
True. Yes, I agree, sir.
It's a step-up business. The moment you have success in one product, you will see a big step-up in revenues and profitability, and then there may be a lull before the next product or products come through.
Sir, this supply of this product, you had mentioned it will be starting in February. So, yes. This will be a more of a gradual pickup, or it will be more of a steady supply which will start from the current quarter?
Well, the supplies are starting this month. Then there will be regular supplies of like our other products will be regular supplies of this product too.
Whether initial supply will be of a small quantity and then gradually it will pick up or it will be more of a normal supply starting from February?
Well, it may take maybe 2 or 3 or 4 months to reach the full rated demand. Okay. It won't be about a year. It won't take a year to reach full rated supply volume.
Okay. Great, sir. Congratulations and all the best, sir, for the future. Thank you very much.
Thank you. The next question is from the line of Nitin Gandhi from KFS Trade Capital. Please go ahead.
So can you share some thought on engineering plastic, which is right now you are operating at 65-70%. How you are shaping it up? When do you see capacity going to 85-90%? What are the developments which will be taking place?
Well, like I said, we are looking at increasing the revenue and top line in FY19 by about 15 to 20%. So that will be a substantial increase in capacity utilization.
Okay, so 65-70 will jump by to 80-80.
Yeah.
Okay, and any realization per ton or margin improvement or any better quality products?
Well, we are going to be looking at improving the basket of higher value products in engineering plastics as well. But being a quasi-commodity, the margin pressures are always there in this business because there are so many players. So while it is profitable, it is not going to be like film or specialty polymer where the margins can go berserk just because of demand supply. Demand supply does not it has an impact that it keeps the margins under control. But it's not like film where you can fall short of capacity and then you may have some
more stable margin.
It's a more stable margin business.
What is that number?
We are doing the EBITDA margin of about 6-7% right now.
Yeah, for film.
And going forward, it will remain in that ballpark. Our target is over the next 3 to 4 years to be able to take the revenue to about 350-400 crores and take EBITDA margins up to about 9%.
Oh, thank you very much. Yeah, somebody was saying something for polyester film also.
What?
While you were conversing, somebody else was saying something on polyester film. So did I heard right? No. Okay. No. Thank you very much.
Thank you. Ladies and gentlemen, that was the last question. And now in the conference, back to the management for closing comments. Thank you and over to you.
Ladies and gentlemen, thank you very much for participating in the earnings call for Ester Industries for the 9 months ended FY18. And we look forward to the next conference call after a few months. Thank you.